Hi, everyone. This is ACC4620 Auditing and Assurance 2. I'm Dr. Gregory, and this is part 2 of Chapter 9, Performing Planning Analytical Procedures. Now that we know the risks that are in the revenue and accounts receivable classifications, we need to start planning the analytical procedures. So we're going to start first with the revenue cycle. If you look at Exhibit 9.6 of your text, you will see that there are some appropriate analytical procedures, including different types of ratio analysis that you want to perform, aging of the AR. So take a look at these because there's quite a number of different procedures we could do. We could look at sales to total sales, receivables as a percentage of current assets and or total assets. So take a look at your liquidity, profitability, and solvency ratios to see what is appropriate for you to use. The next thing you want to do is evaluate the reliability of the data to develop expectations. Just like in every single procedure you're going to be doing, you need to make sure that that data is reliable. So take a look at it. Then you develop your expectations as to, based on what you see, what analytical procedures you might need to be considering in the eyes of any material misstatement. Once you develop those expectations and go through and define and identify unexpected differences. Are there differences within revenue that might be going counter cycle? For example, if you've got revenue based on seasonality, but sales are not going in alignment with that seasonality, that's an unexpected difference. And if you identify these types of differences, you're going to have to investigate those differences and document them. Why are those differences not in alignment with perhaps past history? Now, when we think of the procedures, we've talked about procedures before, but I want to introduce the idea that procedures need to be proportional to the client. So here is Exhibit 9.7, where there is looking at the evidence for the completeness of the revenue. It's one of our management's assertions. So we have two clients. One is a low-risk client. One is a higher-risk client. We may have some higher risks going on. So as you see in the second panel, our approach and the obtaining of evidence is going to be different for those clients. So remember, I think I said this in a prior video, one size does not fit all. We're not going to look at 20% test of details for all of our clients. Some clients who may have been maybe more highly monitored, or we've got very sound internal controls and risks are low, we may only have to look at fewer substantive tests than maybe a company that might be new. They might be a new client or a new company altogether. And so they might be a higher risk. So we want to have more tests within our accounts. Again, when we're obtaining evidence about the internal control, we have to select which controls we're going to test and performing of those controls. Are we looking at entity-wide? Are we looking at transactions? Which control are we going to test? And finally, consider the results of the tests of those controls. Were there any control deficiencies? How severe were they? Was it just one control, one deficiency that was fairly minor? Or was it a large deficiency or multiple deficiencies? You might have to modify that control risk if needed. If there are none, we would keep our preliminary control risks that we talked about in part one, about the same. And again, because our confidence level is high, we probably have to perform fewer substantive tests. Now, when we're obtaining that evidence, the actual substantive evidence, our goal is always to determine reasonable assurance. Remember, we're not looking for 100%, but we have to determine what reasonable assurance is. And that's looking at those tolerance levels of material misstatement. So if we're looking at the revenue cycle, we want to take a look about the accounts, what's going on in the disclosures, and what's management's assertions. Do we have revenue recognition policies based on topic 606 that are appropriate? Are they recognizing revenue at the appropriate level for the appropriate type of good or service they are selling? Is GAAP being followed? Sometimes we forget those little things. We want to create then substantive tests, and those substantive tests are to determine, do the sales exist? Are they appropriately valued? Is there an accounts receivable that existed for that sale on account? Is the balance of accounts receivable reasonable? Do we know whether or not we have changes? And that's where you might be doing some trend analysis, some horizontal trend analysis over the years. Has there been a change in the AR balance year to year? We want to take a look at what analytical procedures we should use. Should we use some ratio testing? We need to evaluate the reliability of the data. Again, we develop our expectations. We define and identify those unexpected differences, and we investigate those differences. Now, focusing just on revenue, some substantive tests could be to determine the existence and the valuation of revenue, excuse me. We might go from the general ledger to the source document. We might take an entry out of the general ledger, and we want to trace it back to see if the source documents are complete and they exist. We want to perhaps look at completeness again by tracing shipping documents to the general ledger. Are the recorded shipments in the ledgers? Are they recorded in accordance to that revenue recognition policy? Do we have cutoff issues? So we want to review the transactions prior to and after cutoff periods. Are there subsequent sales recorded in the future to make the first period look better? Are there future sales that should be recorded in the prior period to make the end of the period look better? Also, look at your sales returns and allowances. Are there subsequent returns for prior sales occurring in the future period? They might be fraudulent sales. They might have dummied up a bunch of sales, put them in the system, and then in the next fiscal period, reversed all those out, or offset them with returns and allowances. When we're looking at these substantive tests for accounts receivable, we normally use confirmations, and we call those third-party confirmations. We send letters to the customers, the third party, to confirm the balances of the accounts receivable at a certain point in time. Now, that adds more quality evidence because it's coming from the company. You mail them to the selected customers, and you have them returned to you and not the company. Why? They might get lost in the company mail. They might get altered. So one thing you do want to do is, because they're being sent to you and they're coming from you, if you start seeing those confirmations being returned because you're using the addresses provided to you by the client, we might be having some fictitious customers going on. So you want to be on the lookout for any mail that's being returned. Now we have two types of confirmation, positive and negative confirmation. Positive confirmation means I'm going to send the letters out, and regardless, I want you to review your balance, make any adjustments, and return the letter to me. Even if it's right, return the letter to me. Negative confirmation, the customer only responds to the auditor if the information is in error. Silence indicates agreement. Now, there's a problem with that, and that's why this type of confirmation is rarely used. Can silence be trusted? Maybe it got lost in the mail. Maybe they just didn't want to respond. Maybe there could be some collusion going on in that company that people don't want you to know about. So you're going to have to follow up. Now, if customers provide a different balance, it requires investigation. Now, the investigation might be that there's just a timing difference between the customer and the client. Maybe the customer records a receivable where they have not yet received an invoice, or maybe that invoice has been adjusted for some returns. So there could be some legitimate reasons why those numbers may not be the same. It could be that the client just missed recording a payment. That's okay, it's just an error. But if the payment was made, you're going to investigate and find out when that payment was made and determine whether the client records are in error or if there may be a lapping situation going on. Were goods returned? If so, investigate with the shipping department and determine if the goods were received back to the company and or credit applied in error. It could be the fraud is going on with the customer and not with the client, where the customer falsifies the information and the goods have actually been returned. Or it could be an oversight by the customer. They forgot that they returned the goods. And there's always cases where there's going to be disputes in amount. It may be an issue between the client and the customer. So you're going to investigate for any correspondence, any email correspondence, any written correspondence that's gone on between the client and the customer regarding a disputed amount. And you can ask of that from both sides. If the amount is disputed, can you provide any correspondence that you have sent, including emails, that may have alerted the company that a dispute was indeed being requested? In accounts receivable, we not only look at this receivable balance, but we have to look at that contra asset account, which is the consideration of the allowance for doubtful accounts. So we want to review management's policies on doubtful accounts. Do they write off accounts after a period of time? If so, how do they do it? What are the spacing periods in the aging of those accounts? And what is a management statement as to 30 days out, 60 days out, 90 days out as to the confirmability if the payment's going to be made? You want to review the estimate for all supporting reasonableness. You want some documentation behind that estimate, that adjusting journal entry in there that says why we've chosen these percentages within the allowing for doubtful accounts. Do we have management's approval? Do we have some confirmation based on policies? You might want to go through and recalculate. You may be given a report, but you might want to recalculate that report to confirm that that report has not been altered. Review those credit policies for indications of allowances. At what point in time do we have the idea that we may be having to write off those debts. And finally, review any correspondence on large or unusually aged items to see if the client is performing follow-up. If their policies state that at 180 days, they sell that accounts receivable to a debt collection agency, and you see something on the books 200 days old, you're going to want to inquire in it. What are some of the fraud risk factors surrounding accounts receivable? Just like revenue, we've got fraud risk factors. Are there lax policies going on with the company regarding extending credit? Are they following their policies at all? They may have great policies for credit, but are they allowing customers with unusually high credit issues or are credit risks, allowing them to be part of that credit? Do we have a lot of credit memos going on and adjustments after year end? It could be that at year end, they are overstating accounts receivable, fraudulent sales, and then going in and adjusting them after the period of time. Do we have credit memos that have no rationale or supporting evidence behind them, or proof that the item was returned? You want to check with the billing department. If the billing department receives shipments back, there should be a credit memo that goes up to the accounting department and matched. You might want to look to see online, do some internet inquiry. Are there customer complaints going on? Poor quality. I didn't receive my shipment. No one's responding back to me when I call to complain. You might want to look at reviews of that company. Remember, we do that when we first start setting the tone of the engagement. Are there unusual entries? Higher than normal for that client. If that client is purchasing pretty steadily $1,500 to $2,000 worth of goods or services, and all of a sudden there's an unusual $10,000 charge in there, you might want to take a look at that. Maybe you want to look at those source documents and make sure that those source documents do not appear to have been altered. Are there photocopies? Examine them. Look at the cash flow statement, the monthly cash flow coming into that company. Do we have inconsistencies or lack of cash flow, especially during seasonal cycles? If season expects there to be high cash flow, perhaps 30 days after a holiday, and you're not seeing it, that might be something you want to investigate. Again, do we have unusual sales appearing at the end of the period and large adjustments at month or year end on sales, which affects accounts receivable? So in summary, we talked about the planning procedures in the revenue cycle. We looked at the risk of material misstatement. We looked at how we obtain evidence. We look at both revenue and accounts receivable substantive tests. We consider doubtful accounts as part of our accounts receivable cycle. And we look at some fraud risk factors. As always, this does not substitute for reading the entire chapter. There's great examples in there. So please do that. And if you have any questions, reach out to me and have a great week.